We're all kind of getting into that post-prandial stupor now. We're all falling asleep. I'm going to do my very best. I'm going to do my very best. As been mentioned, my name is Bob Kline. I'm with American National Insurance Company, Galveston, Texas. I'm very pleased to be here this afternoon. I was struck by something that was mentioned earlier. We were talking about planning for income after retirement. And while I was hearing that, I was thinking, well, one of the things we have to do first is make sure that the money is there to plan for at retirement. And that's really what the gist of my discussion this afternoon is going to be about. We've been hearing this all day, talking about baby boomers, and what was the number, I think 78 million or 108 million or something like that. Baby boomers are going to be retiring here in the next several years. And a lot of those baby boomers own businesses, and they're worried about, how am I going to get out of this business? I don't want to work forever. What am I going to do? How am I going to accumulate enough money in order to retire? For the agent, we're talking about maybe something that you haven't spent very much time on, and that is working with retirement plans. This is a new opportunity for you to generate income for your business. It serves as a very nice door opener. This is the kind of thing that is, we know from all our discussions today that the baby boomers are concerned. And if someone approaches them with a discussion about what can be done about retirement income and a retirement plan for their business, they're probably going to be willing to listen to what you have to say. It also serves as a door closer in that if you're not in there talking to them about a retirement plan for their business, you can bet your bottom dollar that somebody else is. Daytime activity, when we say that, we mean that it's something that you're not out there sitting across the kitchen table at 9:30 p.m. when you really want to be home watching Game of Thrones on Sunday. But at any rate, it also does pay an agent quite nicely. So let's get into some details about how we operate and how we work with the agents. We've had some discussion already today about life insurance policy reviews and why we do them. They're good for the client. They allow you to have a regular access with your existing clients out there. Also gives the opportunity to have a visit with somebody who you perhaps don't have a relationship now, either through referral or just somebody needs a policy review. And goodness gracious, especially after that one we heard about just before lunch, this would be a tremendous opportunity for a lot of folks. And they can be a source of revenue. Don't leave money on the table. Also be thinking about what's going on with retirement plans. Now, when we're talking about this, I think that what we want to bear in mind here is that we're really talking about business owners, and we're talking about, in particular, small business owners. And by definition, at least in our shop, we mean that's an employer with 25 or fewer people. But we can work either side of that, really. The whole idea is that they also probably have set up there a retirement plan, and that plan itself also could stand a review, be it a 401k plan, a pension plan, even a SEP or a simple IRA type of arrangement. And why would you do these reviews? Well, among other things, there's been a lot of change to the pension laws over the past 7 or 8 years that even today, the industry is reacting to, in particular with regard to traditional defined benefit pension plans. When you hear me talk about traditional defined benefit pension plans, I'm talking about your grandpa's pension, the one that pays you a monthly check for the rest of your life. Something that you may or may not have heard of, a cash balance pension plan, and combinations of plans, like, for example, a cash balance plan with a 401k plan. Tremendous liberalization occurred just in terms of really expanding the types of plans that employers can have. They made plans more attractive to sole proprietors. and S corp owners, and they can do things like take loans from the plans. They substantially increased the contribution limits that you can make to, say, 401k plan, as well as the amount of benefit that can be paid out of a pension plan. The Pension Protection Act, I think, was the most important thing that the PPA did, was it gave the green light, it's appropriate for using a green light to highlight that, to something called a cash balance pension plan. And to digress maybe just ever so briefly, what a cash balance pension plan is a form of defined benefit pension plan that expresses its benefits in a cash balance, hence the name, cash balance. So in operation, they look and act a lot like, say, a 401k plan does, but with much, much bigger contribution limits. We'll show you something about how you can do that with a cash balance plan here a little bit later. Allows us to do something like combine a maximum defined benefit plan with a maximum defined contribution plan. So the opportunities really expand in terms of how much money can be put aside in these plans, as well as how much money can be taken out of them at retirement. Reasons why you would want to do a retirement plan review for somebody. One reason is that the current plan costs too much. There's an awful lot of vendors out there who are providing retirement plan services, and the fees are all over the park. And you may well have heard about last summer where people who are in the retirement plan business had to start handing out these disclosures, 408D2 disclosures, in an attempt by the Department of Labor to get some transparency for people out there with regard to the fees that they're paying to maintain a plan. Well, I know that our disclosure runs 48 pages long, and I've seen a lot of them out there that are double that size, so I don't think that this transparency effort is working, which is why you need somebody familiar with these things, looking at the plan to say, okay, what are you really paying? Is it costing you too much? Does the plan still do what the business owner wanted it to do in the first place? Something that we encounter quite often is that a business that has an existing plan, the plan's been there forever, and it's been set up for a prior generation of ownership. Dad is now retired. The kids have taken over the business. Is the plan that we put in place for the business when Dad was running it, is it appropriate now that the children have come on the scene? So that's always a good reason to take a look. And so here's just an example of a review that we did not too long ago for a small business. We had a business owner, 60 years old, very well paid, $200,000 plus, and a number of employees at various ages and salaries in between. And this would work either if it were a traditional profit sharing type plan or a simplified employee pension plan. That's what that SEP stands for. In either case, those plans typically operate by the employer decides that we're going to set aside a fixed percentage of compensation for everybody up and down the line who's in the plan. In this case, everybody got 15%. So the employer contributed $61,200 to the plan. Everybody got their 15%. Everybody was happy. Except our owner at this rate really isn't going to accumulate the kind of assets for retirement that he wants. And he's getting very close. So what could we do to make the plan better for the owner to help him get closer to his goal of retiring, maybe without blowing the budget out of the water? So let's see what we were able to do. There is a technique out there that we are able to use as a result of some of these liberalization of the rules called new comparability. And I'm not going to get into an excruciating detailed discussion of what new comparability is all about. After all, you all just did eat your lunch and you're going into your postprandial stupor, so I don't want to do that to you, other than to say that it works quite well in situations where you have a significant difference in age and compensation between the business owner and the rank and file employees, which is almost always the case in a real small employer. So in the traditional profit sharing type of arrangement, our owner was getting half the contribution to the plan. However, after using the new comparability method, which takes age and compensation into account and length of service, we were able to get 83% of that same $61,200 contribution to our business owner. And so that gets him that much closer now to his goal of retiring when he wants to. Plus, it keeps his cost for providing employee benefits to the rest of the employees more in line with what he thinks he really ought to be spending on retirement benefits. I can tell you that 15% contribution for rank and file employees in a plan is a pretty doggone generous plan. That 5% is a lot more like it with the typical benefits budget that people have. Here's another example. This time we're working with an S corporation. With the S corporations, we were talking about this a little bit at lunch. You can have a business that the owner is actually having income flow through to him from the business of $1 million, but he only pays himself a W-2 salary of, in this case, the $51,000. And for retirement plan purposes, we're only allowed to take into account that $51,000 salary that he pays himself. That distribution that occurs through the S Corp otherwise is considered dividends by the Internal Revenue and therefore unearned income. And since we're only allowed to take earned income into account, we can only take that $51,000 W-2 income into account for our owner. So again, we had the same traditional arrangement where everybody was getting 15% of pay, which, especially in this case, was not particularly lucrative for our owner because he was only getting 30% of the overall contribution. But what we were able to do was to take that traditional profit sharing plan and we converted it into a combination of a 401k plan and a profit sharing plan. I'm assuming everybody is familiar with the concept of 401k, the pre-tax salary deferral, and all that happy stuff. Good. So with this business owner, what we were able to do was that he took advantage of the full $23,000 salary deferral limit for this year. And then he was also able to allocate out for himself $28,000 profit sharing contribution based on his $51,000 contribution using the new comparability technique. So his contribution was $56,500. His actual taxable salary for the year after we took that salary deferral contribution out was $28,000, so that his contribution came out to 202% of his income after we took into account all of the contributions to the plan. And virtually all of it, really, 91% went to his benefit. And we have a very happy owner, because again, he's getting that much closer from $7,600 going into the plan for him to $56,500 going into the plan for him. So what we're trying to do here is help the business owner do really two things. One is reduce his taxes, and the other one is accumulate as much as he can towards his goal of retiring when he wants to, while keeping costs in line for everybody else. Oh, this is one of my favorites, because this uses a cash balance pension plan. I'm kind of a zealot for these things. The rest of the people in my office think I'm crazy, but I enjoy talking about them. This is a fairly common situation that you see out there with a medical practice, where you have an older doctor, and you have a younger doctor, and then you have some employees. Before we did our analysis on this particular employer, they had your basic traditional defined benefit pension plan. And I think that the important thing to remember about traditional defined benefit pension plans is that the contributions in such plans tend to skew towards the older, longer service employees. And so in this particular case, the older doctor, certainly been there a long time, The younger guy, he's got a lot longer to go to retirement, so we don't need to be setting as much money aside for him each year because he's got more time to let that accumulate. And the rank and file are in there getting $7,500. Now, this kind of situation can often lead to friction within a medical practice. Younger doctors say, what the hell, I'm in here, I'm working a lot more than older doctors. He's always out on the golf course. It's not fair that he's getting a contribution attributable to his benefits of $190,000. So, good morning. I told you, postprandial. The younger doctors not happy. So what can we do to keep peace in the family? Well, you can do something called a cash balance pension plan. You can do a lot of really interesting things with these kinds of plans in terms of designing them so that different groups of employees have different benefit levels. And in particular, we're dealing with highly compensated employees, like our two doctors. You are able to discriminate against the highly compensated people as much as you want to. So that allows us some creative plan design. And so what we were able to do was just even out the contribution there. And at the same time, bring the cost of the benefits for the rank and file folks down as well. Get peace in the family. Both of the doctors are still getting a very substantial contribution in that they are getting 97% of the contributions under the plan, and all of that is tax deductible.
Excuse me, can I ask you a quick question?
Certainly.
All right, what if the employer is only one or two?
One person?
Yeah.
Oh, I do many single participant plans. We get asked to do a lot of, say, single participant 401k plans, or we'll get asked to do, I'm going to be showing you something like a 412E3 plan here in a moment that are very popular with really, really small employers like that, maybe a husband and wife.
Yes.
So yeah, we do plenty of those. So here's a myth, that putting life insurance into a qualified plan is going to increase the cost of the plan by the amount of the insurance premium. That is not the case. Let's assume a relatively young employer here, he's 44 years old, wants to retire at 62. He's getting a salary of $115,000. And through the magic of actuarial science, we are able to determine that his monthly pension benefit is going to be just a little over $9,000 at age 62. Without insurance in the plan, we're using a 412E3 plan. Maybe just to touch on that briefly, for those of you who have been around as long as I have, this is the old 412I. All they did was they took 412I and they moved it to its new home at 412E3. For folks who might not be familiar with the concept of 412E3 plan, is that traditional defined benefit pension plan that we were talking about, with a little bit of a twist in that the benefits under the plan are guaranteed by an insurance company that issues the contracts that are used to fund the plan. And so that's one of the things that we always have to remember about 412E3 plans is I'll get calls from people wanting to put variable contracts in a plan like that. You can do that, but it won't be a 412E3 plan. And there's some particular advantages to being 412E3 in that it gets you out from underneath a lot of the actuarial valuation work and funding standards that the traditional plans have to deal with. And the other thing is that they tend to generate, just by their very nature, the largest deductible contributions available in any type of plan. Especially if you include life insurance in the equation. But our friend here, the 44-year-old, we plan just with the annuity alone as your funding vehicle, would have an annual contribution of $99,514. That is certainly not bad. That's a sizable deductible contribution, a nice commission to the agent. But what would happen if we were to put life insurance in the plan? Now, sometimes agents get really excited. They think, oh boy, we can fund the whole thing with life insurance. No, you can't do that. There are limits as far as how much life insurance we can use in a plan. This particular illustration is showing us going right to the limit, where we're showing the maximum amount of life insurance that could be used in the plan. In this particular case, it's just a little bit shy of $4 million for this person. So let's see what happens. The life insurance premium is $66,342. We've also got to contribute to that annuity that we're also using to fund the plan. So $44,431. So the total plan cost is $110,773. So let's look and see what happened here. The plan, same benefit, with no life insurance, would have been a cost of $99,514. The same plan, if we include that insured death benefit, cost increases, but with that $4 million policy in there, the cost of the plan as a whole, same $9,000 benefit, goes up to $110,773. So the cost to add insurance to the plan really is a little over $11,250. Net after tax, that's $6,755, which means that a plan that would, outside of the plan and not being included in the plan funding, would normally have had a $66,342 premium. That policy can be had for an after-tax cost of $6,755. And oh, by the way, all those contributions are tax deductible, because they're part of the plan funding scheme. Yes, sir?
You touched on the question I was going to ask. How does the IRS, because the IRS has been sort of putting the nix on 412I plans here lately.
Well, they haven't been putting the nix on 412E3 plans all by themselves. That isn't what's been wrong with them. What has happened is people have been abusing them.
Right.
And I think that one of the biggest abuses, and I think that actually, I know there's a lot of Californians in this room, I think probably may know of a few where this happened. What was happening is that a policy was being used as a part of the funding for the plan that had an artificially low surrender value up to a certain point. And so with nice big contributions to it and everything. But then what was happening is that that policy was being distributed out to the participant as a taxable distribution with a very low cash surrender value at the time it was paid to the participant. And then lo and behold, 4 or 5 months later, the restrictions on that cash value would all of a sudden fly away, and that cash value would spring. It's springing cash value policies that they were using it as a tax avoidance scheme, and they happen to be burying them inside 412E3 plans. They were also doing some things as far as artificially low interest crediting. They were also doing some things by way of trying to use them as a very short-term plan, 2-3 pay plan, which runs up against the IRS's dictum that a plan needs to be a permanent type of arrangement. It's expected that they're going to be funded over a number of years. Okay? So that's where all these abuses were happening. So where you see those abuses happening, those are listed transactions now. None of the stuff we're showing you here falls into any of those categories.
So for a person who doesn't have a securities license, let's say, and the person wants to do a single person qualifying plan, and they can't do a 401k, a single person 401k.
I'm going to show you a way you can do that, but go ahead.
They want to use this, and the max that they can put in.
That's going to be driven by a number of different factors. The primary driving factors are the person's age and how much he's paid.
Well, let's say it's this person here
This
who's
guy here,
40-some years old.
we took him to the max right here. Okay, our
Okay,
44-year-old friend here, that's as high as I'd be able to get him.
Okay. So
And
when
what
he's doing that-
percentage is it? What percentage is the max?
Well, it's not really expressed as a percentage. It's expressed as the cost of the annuity necessary to provide the pension benefit that we want to pay at this person's retirement age. So, you're used to, say, a profit sharing plan having a maximum deductible contribution limit of 25% of payroll. That's not what happens in defined benefit pension plans. Your maximum contribution to a defined benefit pension plan is the amount you need to contribute in order to properly fund that ultimate pension benefit payable at retirement, okay? So that's why you see us, if somebody comes to us and says, I want a maximum plan, that we will go for the maximum pension benefit that we can pay somebody, which for 2013 is $205,000 a year. And you'll see us going for the earliest retirement age that we can use without getting into grief with the IRS, which is age 62. And especially if you say got somebody who's 55 years old, that means that he's got 7 years to fund up to that maximum pension benefit. Now, there's a whole lot of other things that enter into that dynamic. I don't want to get you too excited. They go, boy, we put away $1 million a year. The most I've ever seen a plan be able to contribute for any one single person is around $330,000 a year, which is certainly nothing to sneeze at. It's a pretty decent
Robert,
amount.
so this client, he has to use an annuity plus the life contract.
That's right. I mean, that's one of the key hallmarks of a 412(e)(3 plan.
Okay.
Is that
An existing policy, like a life insurance or annuity policy?
perhaps one of the things that's in the regulations is that you need to use policies that are issued by the same company in the same series. I've had people come along with a guy who has an existing policy at John Hancock and say that we want to use that in our plan, we can't. And the reason for it is just because the accumulated inflation factors are different, and the whole thing gets all bollocksed up and it just doesn't work.
So to clarify, so this person, the two-edged sword is that he's using the annuity, he's using the cash value, that's his retirement, plus he has a whatever amount of money based on his age and health. He's gonna have a larger death benefit.
Right.
And if he should happen to get hit by an anvil falling out of an airplane, the family wins all the way around.
And just hope the wife isn't the one flying the airplane.
Say that. Say that.
Right, the death proceeds, net of the cash value of the policy and the annuity will flow through to the family.
And per the IRS, he has to start taking distribution at 62.
70 and a half.
Oh, at 70 and a half.
Yeah, he
Okay,
can keep
so
going.
He can keep
You know,
going.
he's our business owner, and so he's gonna have to start taking money at 70 and a half. Yeah, he can keep going as long as he
But
wants.
not at 62.
Right, that's just our normal retirement age. Somebody was.
Just a quick question. Is 412E, wasn't it like pension plan defined benefits that the IRS said has to be only life insurance and it has to be to all employees, not just the employer?
Well, right, this happens to be a sole proprietor we're looking at here, but at its core, a pension plan is an employee benefit plan. And we had this discussion at lunch too, in terms of who has to be covered by a plan. And very quickly, and just in general, if you have union employees whose benefits were collectively bargained, you can exclude them. If you have non-resident aliens with no U.S. income, you can exclude them. If you have, I know that doesn't make a whole hell of a lot of sense when you think about it. But it's in the code, so I had to memorize this stuff for the bar exam, okay? So the others are employees who are under age 21, may be excluded. We use an age, a 1 year of service exclusion, can go up to 2 years for certain kinds of plans. And employees who never work more than 1,000 hours a year may be excluded. So that gets you part-timers out. So that kind of gets you down to your core group of employees that you're going to cover by the plan. So one of the challenges, when we get a census in, is to take a look at that group and say, okay, knowing that we want this plan to be owner-centric, if you will, what kind of plan, given the demographics that we're looking at, is best going to meet that goal and objective. So, I do webinars as well as these kinds of presentations, and I tell people, do not automatically assume that a 412(e)(3 plan is going to be the best plan for somebody, because it's not always going to be. There are other factors that go into the decision-making process besides max insurance and max deductible contribution. But nevertheless, I mean, what we're showing you here is that the business owner here, our sole proprietor, is getting an enormous, really, discount. You know, if he's committed to having that $9,000 a month pension when he retires, he's getting a tremendous discount on that life insurance that's going to protect his family should something happen.
Life insurance have to be disqualified at age 70 and a half.
No, 60 at normal retirement.
Okay. So we have to pay a tax on it.
No, it just stays in the plan. It's until the policy is distributed, you don't pay any tax. Now,
How much of the premium is written off? How much, you said after, can you back, after tax costs and the insurance, and you gotta back down the other?
well,
The premium,
let's remember, what we're really showing here is it's the same plan, just two different levels of contributions. The plan with just the annuity as its funding instrument has a contribution of $99,514. Now, exact same plan, same monthly pension benefit and everything, but that's also using life insurance as part of the funding vehicle. And that's all it really is that the life insurance is just part of the investments of the plan. It just happens to provide that nice big death benefit. Means that we've increased the cost of the plan to the $110,773, but in either case, let's say the guy says, I don't want the life insurance, or I do. Since these are contributions to a qualified plan, that's a legitimate, normal, necessary business expense, both of which are fully deductible.
or uninsurable.
Or he's uninsurable. That happens sometimes. Okay? Do you have to be an expert? No, you do not. That's what we're here for. We work with agents out there all over the country to help them market a complete pension package. We have funding vehicles available, investment advice is available, especially under 401k plans. We have our own in-house administration group, and we do the plan design. That's what my group does. And it's all through us in one place. As I said, our target market is small business retirement plans. And we're able to work with just about any type of plan out there, be it a 401k, traditional defined benefit, cash balance, whatever. We just try to keep it simple for the agent out there. You don't have to be conversant in the ins and outs of 412E3 or cash balance pension or 401k. You really don't need to be talking about any particular type of plan when we first start talking to a small business owner about retirement plans. And some of the suggested approaches to the business owner is, there has been liberalization in the rules. If he has a plan, has anybody looked at it lately? It certainly doesn't do anybody any harm to have a second set of eyes look at their current retirement plan, in particular in light of the changes that have occurred in the law. Unfortunately, there are some plans out there that were supposed to make certain amendments by either the end of last year or the year before that didn't do it, and they've got a rather unhappy situation right now. Or, again, is it an old plan that isn't doing what they wanted to do anymore, but nobody's ever gotten around to it? But I think that the key phrase, as far as I'm concerned, when we're talking to a business owner, is that we will look at that plan for free. We don't charge a nickel to do these reviews. We will look at a plan, we will redesign a plan, we'll provide a proposal, and we'll do all of that for free. And it very well may be costing the business owner money if he doesn't have a plan or if he has an inefficient plan design. Yes, sir?
And at the end of the year, what tax form do you have to file?
They would file a Form 5500.
And how much is that?
That's built into our administration fees, which I will touch on in just a moment.
Okay, cool.
The process is one of, we rely on the agents to bird dog the opportunities for us, to go out and find those business owners, collect the information that we need. Primarily, it's a census of the employees and their salaries and the dates of birth and hire. If they have a plan, we also want to see a copy of the existing plan, as well as the last Form 5500 that was filed. We will then go through the process of analyzing that, prepare a proposal, which we will then in turn give to you and walk through with you so you understand it. And then you're ready to go and present it to the client. Now, we will even get on the phone with you and the prospect to answer questions that you might not know the answer to. So we do a lot of conference calls with prospects who have questions about the plans that we have proposed. So why us? First of all, is the plan design. I mean, who doesn't like something that's free? Our fees are relatively low. We have a variety of different investment choices available. There are options as far as investment management go. We have our own in-house third-party administration team. Instead of having to go to somebody in, I'm going to pick on Brainerd, Minnesota, some of you may know who I mean. But our people they're down the hall and around the corner, so if anything's going on, I can see them. So we're a one-stop shop. We're able to provide everything within one shop. Now, fees, typical plan installation charge is $450. That's a one-time fee. The annual administration fees vary depending on plan size and complexity. A single participant 401k plan, like you were asking about earlier, would be $400 a year, an annual administration fee. By the way, the employer pays those fees. Those are tax-deductible items as well. The other thing I would point out is that for a brand new plan, for a plan that covers employees as well as the owner, the government gives the business owner a tax credit to help offset the cost of establishing and maintaining that new plan. IRS Form 8881. So it's not a bad thing. Now, you were talking about not having a securities license. We have our WealthQuest 3 non-registered group variable annuity product. And bless you. And I want to emphasize non-registered group variable annuity because there is a provision in this 34 Act that exempts from registration insurance products that are sold to fiduciaries of qualified plans. So guess what we're doing here? We're selling a group variable annuity insurance contract to the trustee of a qualified retirement plan. So we fall into that registration exemption, which means that that product that's being sold is not a security. So in the vast majority of states, you don't need to have the securities license to sell it. There are two states, Connecticut and Massachusetts, that say, yeah, we know, but we want the people selling it to have the requisite knowledge and background and blah, 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 to sell it, so they must have the license to sell it. And there's one state where we don't have the product available in yet, and that's New York, but we're working on it. But in California, Texas, Arkansas, and everywhere else, you're fine. Yes, sir.
If the VA, it's not a registered product, if the VA doesn't perform, and it's the only variable option in this 401k, as an example. And because it's not a security, does the fiduciary, the owner of the company, still have, or have any protection against being sued by its employees?
We'll talk about that in a second. First of all, I think that 404C2 of ERISA would probably cover them anyway. That's my opinion, it's not advice. Because it doesn't really, 404C2 doesn't talk about any particular type of investment or whether it's registered or no. And as long as you're offering a broad range of investment options, such as this contract does, it has 54 different options available for the participants to choose from. And they're managed by names I think you've heard of, T. Rowe Price, Fred Alger, Invesco, Fidelity, etc. And it has funds that are designed for just about any risk profile out there, from fairly conservative, such as money market funds, and fairly conservative, very conservative.
Are you talking about the funds within the variable annuity or
Yeah.
separate funds?
They're separate accounts within the variable
And it's
annuity.
still a variable annuity.
Yeah, right. I mean, that's the very
You call it a
specific.
mutual fund, but it's a separate
On
account.
the version of this that's on my laptop, It does not say mutual funds. However, it got here before I could take that out, okay? But to be very technically correct, it's a separate account under the group variable annuity contract.
Because the surrender charge is different on the two accounts.
Right. But I will say this much, though, is that they operate very much like their street mutual fund brethren, okay? And as I said, we've got it from aggressive growth such as international equity, the various equity offerings of both small, mid, and large, growth and value, sleeves are there, bond funds are there, target date funds are there, sector funds such as healthcare and utility. And what we tried to do here was make this very useful to the 401k marketplace, where the accounts are largely participant directed. Now, some participants are scared to death of trying to manage their own money. And this is getting into a little bit about what you were asking about fiduciary responsibility. We've entered into a strategic alliance with Morningstar. And the idea is that Morningstar will make itself available to the plan participants who don't want to manage their own accounts under, say, a 401k plan. And there's really two different ways you can go about this with Morningstar. There's a do-it-yourself approach where Morningstar puts all their web tools available to plan participants so that the participants can model what they want to do themselves at no cost to anybody. Or the participant can hire Morningstar for 50 basis points a year, and Morningstar will actually manage the account for them. But I think what we want to bear in mind here is that any type of business entity can have any kind of plan. You know, it doesn't matter if they're a sole proprietor, S Corp, C Corp, you know, LLC, it doesn't matter.
In your office, is there a fixed annuity option?
Oh, sure. Yeah, but it's structured differently, but you can do that. Every business owner out there is a prospect. We know there are thousands and thousands and thousands of small businesses out there, whether they have a plan or not. Do you? And if you don't, we can help you with your own particular situations. The potential is life sales and DB plans, rollover of assets in 401k if you take over 401k plans. That's a very nice, or you establish a new one for a company where somebody's got a substantial IRA that they want to roll into the plan. You're bringing stuff to the table. You're not out there being passive and just be happy to collect the commissions. And it starts the dialogue with respect to other products and services that you have to offer. So it's a great time. I mean, we've been really busy too. That's the amazing thing. Even though we've been in a bit of a downturn, we've been doing really well. This is the team. Truett's up there, who naturally had himself put at the top as my boss. That's me down there in the corner. And I would encourage you all to visit our pension sales website, which is pension.anacoweb.com. There's marketing materials there on the site. There's a place there we have stored webinars that we have done in the past that you can listen to at your leisure, and so on. And there's our beautiful building in Galveston, on the island that's slowly but surely sinking into the bay. Yes, losing about a half an inch a year. Any other additional questions? Yes, sir.
There's usually almost nothing I can do for, especially people that I employ for big companies. I've been looking at all the things we can do for small business owners.
Well,
So if somebody's employed by a big company, ironically, a lot of these people, they get a lot of money, $500,000 a year. They're trying to find ways to shelter this money from taxes. Any thoughts on?
Well, it's a little beyond the scope, and I know I'm running behind, everybody's been. If the person is a high enough up executive in his business, he ought to be able to approach his management team to talk about perhaps a non-qualified plan.
No, if they walk for $500,000.
Yeah, well, that's usually something that they already have.
They all have.
If they don't,
Sometimes
there's
they don't.
something wrong with it.
Or they don't qualify.
Because well, you know, Having once worked for a Fortune 500.
Guys, I want to make this clear. This whole fund was for small businesses, as you pointed out. And that's what American National does well, that's their plan design. They do so much of the work for you, they've been in it a long time, it's a really well-kept secret. And it's a great tool. How many people in here have small business owners as clients? This is a no-brainer. I mean, really, I hate to say it in front of Robert, but they do the work for you. And we have a great contract with American National. You actually get paid well to do that.
That's not